U.S. natural gas futures fell below the $4 mark following the latest report from the EIA, which revealed a larger than anticipated increase in storage levels. According to the EIA data, U.S. utilities injected 9 billion cubic feet of natural gas into storage for the week ending March 14, significantly exceeding market expectations of a modest 3 billion cubic feet build and surpassing the 5-year average withdrawal of minus 31 billion cubic feet by an even wider margin. Energy traders noted that forecast decline in gas demand should allow utilities to keep adding the fuel to storage in the coming weeks. As I've emphasized in my previous forecasts, the storage surplus is shrinking at an even faster pace than initially anticipated. Just 2 weeks ago, projections shifted from an expected increase in the deficit to a decline, forecasting a drop from minus 320 to minus 290 billion cubic feet. Then, in a dramatic turn, the forecast contracted to minus 164 billion cubic feet just 10 days ago, fell further to minus 147 billion 4 days ago, and today, it is expected to shrink to around minus 120 billion cubic feet. This accelerating bearish trend is impossible to ignore, even for the most stubborn speculative bulls. The longer they attempt to keep prices elevated despite overwhelmingly bearish fundamentals, the sharper and more inevitable the correction becomes. It's not a matter of if, but when the market forces a reality check. Another bullish argument from speculative traders is the rise in LNG exports, with flows to U.S. export terminals reaching a robust 16 billion cubic feet per day. While this figure has remained consistently high over the past few months, it's crucial to recognize that the significant storage drawdowns seen earlier this year were largely driven by the freezing cold in January and February, not LNG exports. Now, with exports running at full capacity, they have had little to no impact on the rapidly approaching shift from a storage deficit to a surplus. Well, at this pace, storage levels could stabilize around 200 billion cubic feet by the start of the cooling season. Under these conditions, natural gas prices are likely to settle below the $3 mark once injections begin accelerating. Meanwhile, weather analysts anticipate a warming trend across the west and central U.S., while cooler temperatures are expected to settle over the mid-Atlantic in late March. This mixed weather pattern could lead to a noticeable decline in natural gas demand, potentially dampening price volatility unless a more intense cold front emerges to disrupt the outlook. From a technical perspective, the inability to break above the $4.20 resistance level signals that sellers remain firmly in control, increasing the likelihood of a pullback toward $3.90. If bearish momentum continues, prices could extend their decline, potentially breaking the key support level at the 50-day moving average, which is now coming into focus. Drop your thoughts in the comments. Do you think natural gas has another shot at breaking the $4 resistance, or has the inevitable downturn already begun? Please like, subscribe, and comment to support the channel. See you in the next one.